Welcome back to another episode of FPO&G, Financial Planning for Oil and Gas Professionals. This week on the podcast, we're going to talk about how to fire your advisor. We're going to uncover some research that supports our idea of client retention rates are really high, but satisfaction isn't necessarily as high as retention rates. And so we think that, breakups are hard. And so we're going to empower people to talk about how to break up with your advisor, because we're very pro advisor. But we also acknowledge this reality in our podcast a lot of, hey, the bar for an advisor is high. And we would go as far as saying the average person is probably underserved by their advisor relative to the fee they pay. So we're going to talk about that. But Justin, you got some exciting YouTube updates. So why don't you share those with us?
We're doing a few things on YouTube. We are putting a lot of our clips on YouTube Shorts. I am planning to do more of my sketches. So if you've ever met me in person, you know that I spend a lot of time on a whiteboard, whether it's an investment, tax, estate planning idea. I greatly prefer drawing out an idea rather than just talking about it. So I'm excited to begin doing more of those on YouTube. And for our listeners today, not many people listen to our podcast on YouTube or watch our podcast, I should say. Most listen to our podcast, whether it's on Spotify, Apple, or another application. But today you can investigate Jared's new facial hair. So there's a little nugget to say, go check out our YouTube channel and give us some feedback. Give Jared some feedback on his new facial hair.
Yeah, to the three of you who listen on YouTube, I need your help. So let me know what you think in the comments. Awesome. So with that, let's dive in. So I want to talk about two pieces of research, and then we'll also talk about some anecdotes, right? And to kind of frame up this conversation. So, it makes sense. Like, people endure suboptimal outcomes because the cost of switching is high. Not high in a monetary sense, but high in a relational tension. And it's just awkward, right? So McKinsey did a report studying wealth management firms, and we'll share these in the show notes, but they found their annual attrition rates to be 1% for the bottom quartile of advisors and 8% for the lowest performing quartile of advisors. So that means that both the best performing and worst performing advisors had retention rates of over 90%, right? And so that signal would tell us that, hey, advisors are doing a pretty good job, and people are generally satisfied. But conversely, there's a study that the CFA Institute did on trust by profession, and 32% of respondents had low levels of trust in financial advisors. And that's just a general audience. So even if you look at retail investors with an advisor, only 57% gave a high trust score to the financial services industry. So on the one hand, you have really high retention rates. And on the other hand, you have an industry that has lower levels of trust. And even people with an advisor don't express high degrees of trust. Justin, how do you square those two things? Why do you think that is?
I don't think you can square those two things. I mean, it's really fascinating. Even if you are a kind of, I don't know how to say this in a nice way. Even if you're a pretty bad firm, even if you have a really bad reputation, which in our industry is typically the firms that just sell a ton of insurance products that people don't need, your retention rates are still sky high. So there's not really a way to square those two things up. I mean, it's just fascinating that the kind of public perception is huge lack of trust. But on a personal level, almost no one takes action to change their advisory relationship.
And why don't you think they change, right? Like if there's something in the back of their mind telling them, hey, this is probably suboptimal, or I'm probably getting underserved, or even I've listened to a couple podcasts and Brownlee's told me what a good advisor does. The FPOG podcast hosts have told me that. Where do you think people get hung up?
I'm going to just think out loud. I do think there's an element where pride probably plays a role. I think that's potentially a dynamic where for some couples, a lot of times the male kind of drives the decision. And so there could absolutely be a dynamic at play. where the male makes a decision and is unwilling to go back and say, hey, I was wrong. I'm wondering if that's it. I mean, Jared, I legitimately think it's like bordering on Stockholm syndrome in the worst instances. But I think there's a dynamic where maybe it's pride, maybe it's unwilling to say, hey, I was wrong here. I made a poor decision. And then I also think it's not a pleasant process to go call, interview 5 different advisory firms and change. And then it could just be synergy and laziness and the idea that, hey, not only is it not pleasant, I don't want to spend my free time talking to financial advisors to make a change. So I think kind of all of those dynamics could be at play a little bit. What do you think?
Yeah. I mean, I think like a lot of times people find an advisor not based on technical competence, but relational proximity, right? So like there's some like relational equity that's mixed into the advisory relationship versus just being on the merits of, hey, do I value the advice that you provide me and the services that you provide me at the cost that you're providing them at? Right. And most people, like, that's not how they're introduced to an advisory relationship. So there's some relational components tied to that make it a really, really delicate conversation. And kind of like you said, right? Like inertia is powerful, right? Like you have to have a tough conversation and then you have to do the due diligence of like finding someone else that's aligned, right? Like it's just, and it's one of those things, it's important, but it just kind of can easily become not urgent, right? Because, it's just like, it's so much easier to maintain the status quo. But like, so that's the data, right? That's the data that we're kind of talking about. Have you seen this in our business at all? Like specifically us, like, do you have much experience with like this reality? And if so, like, what does that look like?
One example really comes to mind. So this was actually at my prior job. This is almost a decade ago, but it was one of the single worst fee situations that I've ever come across. So I'll make it totally random and kind of give an outline. But there was a family that came to me, and they were retirees, and their current advisor was managing about $5 or $6 million, and the all-in fees were about $110,000 a year. And so a few things that I want to point out here. The point of this story is that I do think, Jared, there's a dynamic where the baby boomer generation almost exclusively hired a financial advisor based on relational referrals. Who did my friend work with? Who did this person at work? Who is their advisor? And referrals were almost exclusively how they hired financial advisors. And I mean, we've talked about this on the podcast. 99% of advisors in 2004 were terrible. The fee only movement was tiny. You were almost certainly working with a broker who was charging awful commissions and selling you things that were not in your best interest. Our industry is slowly evolving and has gotten better. And there are some better fee-only options available today. But if we think about that baby boomer generation, that's how they made decisions on who their advisor would be. Jared, I would contrast that with millennials. So right now, millennials, I think the youngest group in millennials are early 30s, and the oldest is mid 40s. Millennials do not hire an advisor that way. They will take a referral from a friend or a colleague, and then they will Google that person. They will look at 5 different angles to figure out, who is this firm? Do I trust them? In what ways are they not ideal? There's just a level of cynicism in our generation that has totally changed the way that people hire advisors, arguably in a very good way. I think it's been a positive change. But the example, I'll go back to it from about 8 or 10 years ago. So I'm working with this family, and they come in kind of for a second opinion. They have no idea the fees that they're paying. So they were in 2 or 3 different annuities. And the 10-second version is that those annuities had 5 different fees embedded in them. And the all-in cost for those annuities was over 3% per year. There was then another part of their money was managed just in investments and in U.S. stocks, and they were paying their advisor 1%. And then that advisor was contracting out the investment management to an SMA at a different company. And that SMA was also charging 1%. And so they had, I mean, it was like a $1.5 or $2 million stock portfolio, and it was being charged 2%. And so if it was 2 million, that's 40,000 a year. And then they had millions in annuities that they did not need at all. They were being charged more than 2%, more than 3%. And so, this example was, hey, they found their advisor through friends, through relational referrals. And I think maybe they went to one of those steak dinners that the advisor put on. And so they went to a steak dinner, the advisor sells them. And 10 years later, they have now paid 7 figures in fees to this advisor. And none of their investments are performing overly well because investments cannot perform well with fees at that level. But that's kind of an example of how, and I think it's shifting again, it's shifting in society. But the way that people hired advisors 10, 20 years ago was just totally out of whack. And it led to extreme suboptimal situations. And here's the thing, Jared, even firms like those have 90+% retention rates. There are so many families that keep their 3 million, 5 million, 10 million or more invested in firms like those for one reason or another. And yeah, I think that's probably the most stark example that comes to my mind.
Wow. So did those people stay with that advisor in light of you doing, like showing them and making that known to them?
Nope. So that example, they immediately left and we consolidated assets in a drastically lower cost portfolio. And they have been very grateful for that ever since.
Yeah. And I mean, the anecdote that I would add is we have had several intro or discovery calls with potential prospects, looked under the hood, identified the fees they were paying, talked through the services we provide. And, the pitch basically is, hey, we'll give you more than you're currently getting and you'll save substantial amounts of money in fees every year. Are you in? And we'd hear no or crickets. And we were dumbfounded as to why we thought that was. And in light of kind of the research and just the reality of breaking up is hard, it makes sense. So Justin, with all that framing kind of behind us, let's talk about how, right? Let's say you've identified, hey, okay, this is something I want to do. I want to make a change. It's a hard but necessary change. What advice would you have to someone who's trying to do this?
I think the very first framework that every family should adopt is something that, Jared, you and we repeat this a lot internally in our firm. But if you are hiring an investment advisor, never forget that this is your money. One thing that's really important to Jared and I and everyone on our team, this is not our money. It belongs to the families that we serve. And so I do think there is this dynamic. Jared, we've had instances where we've won business and then the other advisor kind of reaches out to the client and really guilt trips them. And why are you leaving me? And then why would you do this? And so I think the very first piece of advice is your money does not belong to your advisor. It is yours. Every client that Brownlee Wealth Management serves, it is our client's money. It is not ours. Jared, it is fun to share that, we hit about 250 million in AUM. So in the assets we manage, we hit that in about 4 years, which I'm grateful. I'm thankful. And it's an exciting thing to hit. And I think by any metric, we are one of the fastest growing firms in the entire country. But Jared, I never want us to lose sight of the fact that that's not our money. It belongs to the families we serve. When we share our AUM and the story of our growth, I want the first thing that listeners come away from, I want them to be impressed with our clients and what they have done rather than, oh, wow, look at Brownlee Wealth Management. So that's the very first thing. And I cannot emphasize this enough. That has to be your mindset. Your money does not belong to Merrill Lynch. It belongs to you. You are the steward of those assets. And I think you should take an annual I really think you should take inventory every year. This is my money. And I have entrusted it to Morgan Stanley, JP Morgan, or insert firm here. And it should be up for debate on an ongoing periodic basis.
Yeah, I love that, right? Just like stepping into it with the framework of, hey, of like ownership and power, not like guilt or I shouldn't do this, right? Like the stakes and consequences are too high not to optimize your balance sheet, right? Like a decision with 7 and 9 figure consequences is worth the awkward conversation. But so even just like having that framework of like feeling empowered and remembering, reframing, hey, this is my money is a great starting point. I would also say let the TOAs do the talking, right? So like you're actually not legally required like to give them any heads up before it happens. And you don't even need their approval to move their account. You move your accounts, right? Again, it's your money, it's your accounts. And they will be notified if you work with a new advisor to transition those accounts once the transfers have been initiated. And so you don't like, it's up to you whether or not you even want to have the conversation or feel the need to explain it. We see with people sometimes like, hey, I have relational equity to this person or I have history. So like I want to honor that and I feel like it's worth a conversation. Totally get that and understand that. And we'll talk about how we help people with that. But if you do want to do that, I would recommend that you have that conversation after after the transfers have been initiated. It just it reframes the tone of the message. If you're saying, hey, I'm just giving you a heads up, this has already happened. We thank you, appreciate you. Here's why we're making the change. Or here's why the change has been made versus, hey, we're thinking about doing this. Because if you leave the door potentially open, that's when the guilt trip might come on. That's when the convincing and the badgering of and trying to talk you out of a thing that you've made over time and with a clear and level head before getting sucked into the kind of emotional vortex of a breakup. So just to say, hey, let the TOAs do the talking. But if you feel the need to have a conversation, which totally makes sense, maybe just wait to do that till after the transfers have been initiated because it reframes the conversation and it's just a little more productive, we found.
You hit the nail on the head 10 minutes ago that one of the reasons people don't make a change is because it's miserable to, do that. And so you're making an already unenjoyable process significantly more unenjoyable. And so, yeah, if you tell your advisor, hey, I'm thinking about making a change, prepare to get pestered. And they're going to want to change your mind. So could not agree more with that. I also, Jared, I think about the golden rule. How would I want to be treated? Like if a client of ours goes to another firm, Jared, I have no problem if they do the transfers. And one, if they never tell us, or two, if they tell us after doing the transfers, I have no problem with that. And I don't think less of a client for doing that because it all goes back to that underlying principle that should be at the forefront of this conversation. It's not my money. It's not Brownlee Wealth Management's money. The money belongs to the client. It is always their obligation to do what they deem is in their best interest.
Yeah, and candidly, if they want to give us feedback on why they made the change, I'm not entitled to it, but I would appreciate it, right? Because like we want to get better. There was some unmet expectation, right? Like I welcome that's a piece of feedback, right? And maybe it wasn't a good fit, or maybe they were, a great fit when we started the firm, but now we've changed, and so right, like I'm not entitled to the answer, but being honest, it would be helpful because right, like, and if we're constantly wanting to get better and learn and add value, right? And so if somebody thought the value wasn't there, that'd be a piece of data that I'd want to know.
And I think that kind of highlights, I do think, a big reason, just like you said, a big reason why people stay in suboptimal advisory relationships is they kind of just feel bad about doing it. And at the end of the day, that should never even play a factor in being a good steward of your money. Especially at the level we're working with it, it's often, hey, you're investing a lot of money with this firm and you're paying them at least 5 figures a year, sometimes 6 figures every single year. Always helpful to say, hey, what are my fees going to be over the next 10 years? And really that helps kind of highlight the fact that, hey, you are not stepping over a line. You're not being mean. if you make a change. This advisory firm has already collected hundreds of thousands or even millions of dollars in fees from you. You have given them above and beyond what they deserve.
Love it. So good. So let the TOAs do the talking. And then if you feel compelled, timing of the conversation, maybe after it's already been initiated. So so the advisor can't convince you. But what do you actually say? I mean, I would spell out why, I think it's helpful. Kind of like what I said, getting the feedback's helpful. Like whether it's, hey, I want a fiduciary, or I like the fee model, or hey, I want to cut fees, or hey, you're a generalist. You work with everybody. I want somebody with expertise in my situation. Or hey, I'm one of hundreds of clients with you and I want a smaller client count. Whatever the reasons are, I would share those. And so, I would also think of those beforehand. If you're going to call them, I would have a list of talking points, because it could be an emotional conversation and it might be better to just send as an email. And that being said, we've helped a client or two break up with their current advisor. So we have a advisor breakup letter that we send to new clients with existing relationships, because honestly, the vast majority of clients who come to our firm have an existing relationship that they're underwhelmed or unsatisfied or being overcharged for. So we help people with that. So if you want a copy of that, shoot us an email, podcast@brownleewealthmanagement.com, and we'll be happy to send you a copy of our advisor breakup letter. But so, in the letter or the phone call, right, I kind of spell out the reasons why, and then kind of ideally you send that as an email. But if you do have a phone conversation, maybe articulate your thoughts and have them lined up before, because it could be precarious or an emotional conversation. Justin, anything you'd add in terms of, okay, actually, we talked about when, but the how to break up?
I think that sample letter that you've created, Jared, is really effective, but would also just highlight again that it's completely optional whether you say anything. And back to that golden rule. Like if we are broken up with, if a client breaks up with us and goes to a different firm, I think it's completely fine if they give us feedback or if they don't. And so I think both options are completely above board.
Awesome. And one common myth I want to just dispel as kind of as putting a bow on this conversation. So hiring a new advisor does not necessarily mean your entire portfolio is going to be transitioned and there will be a huge tax impact to you. So that's just that can happen, but just assuming that will happen, and that not switching advisors because of that potential reality isn't a good reason to not look for a change if you're thinking about it. So generally transfers are in kind. So what that means is the securities you have at the old custodian will show up at the new custodian, assuming they're transferable, which most publicly traded securities are. So just by switching, there's no tax impact. But ideally, a good advisor will review your existing holdings, see how they map to your current holdings, and then transition tax consciously, or hold stuff as equivalents, or kind of work around your embedded capital gains so they can get you closer to their model portfolio without incurring a bunch of capital gains. So that's just kind of one call out I see that I wanted to make people aware of is, hey, switching advisors does not necessarily mean capital gains. And it can if you just find an advisor who's going to throw you in a model portfolio and doesn't have the software to work around your embedded gains or your legacy positions that you want to continue to hold. So just want to make people aware of that. Justin, anything else in terms of firing your advisor that you want to bring to our listeners' attention?
I think you really covered it all. I just think a lot about back to that idea of every person at the end of the day, they are the steward, and that they're kind of the managing director of their entire balance sheet. A lot of people like to, kind of verbiage is you incorporated. Pretend that you and your personal finance is its own company and you're the CEO of that company. So I think it's always helpful to take inventory. Hey, am I being significantly overcharged? Am I one of 300 clients here and I maybe get one review meeting a year and maybe 4 canned emails? Is my advisor reviewing my tax return? Is my advisor reading my will or trust? If those things are not happening, you should be asking why. You're the managing director of your balance sheet. And I think it's always behooves you to just ask the question, can I get a sharper, financial plan? Can I optimize different parts of my next 10 years. And so I think that really covers it.
Yeah, so good. Yeah, I just want to reiterate one thing I said is the cumulative cost of advice and the stakes of optimizing a 7 to 9 figure balance sheet are too high not to do what's best for your family. The stakes are just too high to not do something about it, even if that means an awkward conversation. And so we hope for those of you that are getting underserved and on the fence that you feel empowered, whether it's to hire us or somebody else, that you just take it upon yourself to find out what's best for you and your family and begin to ask the questions. Love to hear from listeners. Love ideas for future episodes. Thank you for tuning in. Share, subscribe, podcast at brownleewealthmanagement.com. Thanks. We'll see you next time.